So not everything's going to win. There's a lot of optimism.
Yeah.
Obviously, we're going to probably have a new record close on the S&P. You don't like energy. Let's just start there, okay? What happened to drill, baby, drill? I mean, that's what he's talking about all the time. He just declared a national energy emergency. There seems to be more optimism about that space, no?
More optimism, but drill, baby, drill is not necessarily good for the stocks, right? A couple years ago, if you recall, it was all about growth, growth, growth. Didn't work out so well for multiples, didn't work out so well for earnings. Then they got religion, they got profitability, and that worked out pretty well. So we're not seeing this as drill, baby, drill as a positive. The other thing is, just because you say drill, baby, drill doesn't mean that it happens.
Okay. Yeah. That's a good point you make. It's a point that Kramer made yesterday morning that I discussed on this program as well. What you're essentially saying is that the president, with all due respect, can say drill, baby, drill all you want.
Right.
But the companies have sort of changed their strategy on their businesses where they don't want to drill that much.
Correct.
They want to return more cash to shareholders because they've seen what it's done to their share prices.
Exactly right. And what we think about is we would turn more positive on energy if we thought global growth was stronger, if we thought inflation was going higher. That macro picture is really positive. But when we look at China, we look at Europe, things still aren't where they need to be. And we also think that inflation is not accelerating. It's just more or less flatlined right here, which isn't great for the commodity, isn't great for the energy companies.
You don't like tech hardware either.
Yep.
Is that an Apple? Like what are you talking about when you talk tech hardware?
Apple is part of tech hardware. So the reason why we don't like tech hardware is you're paying a premium valuation, but you're not getting premium fundamentals, right? And the stocks are beginning to roll over, right? Which in a momentum market is not something you want to see. And we think there's plenty of scope for downside. That rollover is really important. And as a result, we want to stay away. We think there's a lot better risk rewards, a lot better opportunities in the marketplace than paying up for just okay fundamentals.
Okay, such as what? Where are the opportunities?
So the opportunities are still in the communication space. You saw what Netflix did yesterday or last night, right? We still think that is the quintessential GARP sector. You have good valuation, you have positive momentum, improving fundamentals, and the stocks continue to work. And this has been for almost 3 years now. And what's funny is valuation is still trading at a discount to the market.
So Meta is in there?
Meta, Google, Netflix, you have some cable companies as well, and a handful of others.
All right. Everybody now seems to be all bulled up about the banks.
Yes.
For obvious reasons, right? If there's one sector that folks think is going to do well under Trump 2.0, it's the banks. You get more animal spirits, you get more deal making, you get deregulation, banks can be banks, shackles are off, blah, blah, blah. We've all heard it. What don't we know, though? I mean, the stocks have already done pretty well.
Well, one of the things is people are very positive on the banks, but they're not positioned that way. They're not a lot of people are not overweight the banks. They're still saying, well, I think there's going to be a pullback. Well, I'm not so sure about it. Oh, valuation versus the last 10 years, not so great. The other thing is, regulation hasn't changed. We've just turned the calendar. We're getting new people at the SEC, the FTC. Mm-hmm. The enforcement hasn't changed, right? We're hearing more about M&A and M&A activity, but that's just the beginning, right? We haven't seen the IPOs. We haven't seen the associated trading. And so the E is going to go higher. We think the E is going to go higher. In addition to that, the multiple hasn't expanded enough. You've had 15 years of upward regulatory pressure. That's not resolved in 3-6 months.
What's your overall view for the stock market this year? Do you have a target yet?
We do have a target.
No, I'm serious. You put one. I didn't mean to make a joke about it. I'm serious.
So we're 7007. So we think the market gets to...
Oh, that's right. I forgot about that.
That's right, yeah.
Forgot about that. 700.
Yeah, how
7000 wasn't good enough for you.
No, it wasn't good enough. So
what's going to get us there?
What's going to get us there is exactly what we're seeing, right? People are worried about, oh, tariffs this, tariffs that, Trump this, Trump that. Look at the fundamentals. The fundamentals are pretty damn good, right? In addition to that, you have an economy that I think is better than expected. You have credit spreads that are still very tight. You have the cost of capital beginning to come down, and it's not exceptionally high to begin with, and M&A is just beginning to kick up. So you throw that all together, and you can see the S&P go higher just following growth and growth rates without much, if any, multiple expansion.
All right, we'll leave it there. Chris, good to see you again.
All right.
That's Chris Harvey, Wells Fargo Securities.